Okay, so we'll now start with the second reading, time value of money. Now, ironically, this topic should have been limited only to present value and future value and annuity related calculations. But what the institute has done is that in this topic, they've mixed up everything, equity, bond, wherever the time value of money calculation is supposed to be, they've covered everything into this. Now, what I realized is that, while when you start doing CFA, if you start with QM, and if you come to this second topic, you will be kind of lost here, because you can't do many of these questions unless and until you've covered Gordon's growth in equity or bond calculation and all, or probably related binomial related aspects. If you've not done all this thing, then you'll find this quite complicated. In fact, they've put interest rate parity, which comes from economics, also into this. So this topic is just not time value of money. It's like a revision of all the calculation that you're going to come up in quants, equity, fixed income, somewhat in derivatives, hedge fund related calculation. You already saw alternatives before topic, and also related to which topic am I missing? Bonds, right? Yeah, everything. All of that is included in this one topic. Okay. Initially, this wasn't the case. Initially, time value had only present value, future value calculation. Now they've combined everything. So I recommend this topic generally to be done when you are done with the overall reading once, because then otherwise, if you're not aware what is Gordon's growth and all, you won't be able to do this calculation. Now, the reason that while I'll be doing this topic, it's going to be an indirect revision of the bonds and equity and other topics also. Okay. Now, to solve this, I'll be using the time value function, but my habit generally is that first I write down the components, then I go into the calculator function. Okay. So let's do that. First, Grupo issued 10-year corporate bonds 2 years ago. So when they say 10-year corporate bond 2 years ago means the remaining life you always keep 8 years. The bond pays annualized coupon of 10.7% on semi-annual basis. First of all, my coupon is 10.7% and everything is semi-annual. So this you will do multiplied by 2. This you will do divided by 2, half yearly. Okay. Current annualized YTM. So YTM is 11.6. This also you'll divide by 2 because it's semi-annual bond. The current price of the bond is closest to. Now they haven't given you the face value or the par value of the bond, but by looking at the choices, I can conclude that the face value would be around 100. That's why I have 90s in the prices in 90s. So my face value is par. Compute PV. I will do this. So of course, I'm not going to the calculator. You can easily do this. 8 into 2, 16 will be your N. 10.7 divided by 2 is your PMT, payment. Now guys, here if you assume the par, this question not, but if there was, the prices were in thousands, then you would do 10.7 percentage of 1,000. Okay. Here I've kept 10.7 only because it's the face value is also 100. 10.7 divided by 2 will be your PMT. This will go into N. This will go into PMT. This will go into I by Y. So I do 11.6 divide by 2, I by Y, 100 FV, and then press compute PV. You'll get 95.38. Don't worry with the negative sign. So 95.389. That is 95.4. Am I correct? 16 is my N. 10.7 divided by 2 is my PMT. 11.6 divided by 2 is your I by Y, 100 is your FV, compute PV. I get 95.39. So 95.38 or 39. Is everyone getting this answer? Everyone? Yes, the answer is then C. Clear? This is about bonds. Got it? Anyone, any questions in this? No? Okay. Next, This real estate seeks a fully amortizing fixed rate 5-year mortgage loan to finance 75% of the purchasing building costing purchase price of a residential building, that is 5 million New Zealand dollar. Now, this is a mortgage. Fully amortizing mortgage means you have to calculate the installment amount, which is combination of interest and principal both. That's a fully amortizing loan. Okay, so when you take a mortgage, it's a fully amortizing only. So here I will take into consideration 5 years. So my N is 5 year. 75% of the amount will be my loan, 5 million into 0.75. So my loan amount today that I'm going to get is 3.75. Okay, 3.75. Clear? 75% of 5 million. Annual rate on the mortgage, that is my interest rate on the mortgage, will be I by Y will be 4.8%. They have asked me the monthly payment for the mortgage. So everything has to be done monthly. This has to be multiplied by 12. This has to be divided by 12. Now, what are we calculating here? The monthly payment. So we are calculating compute PMT. But for doing that, we require FV. And in a fully amortizing loan, when the last installment is paid, nothing remains. So your FV has to be 0. In a fully amortizing, FV, future value is always 0. Got it? Let's do this. 5 into 12 will be your N, 3.75 million. You can just write 3.75 as your PV, 0 as your FV, 4.8. Now, 4.8 divided by 12 will be your I by Y. Compute PMT. Now, when you get compute PMT, you might get answer in 0.0 something. This you can multiply with 1 million to get a proper answer. 1 million, if you multiply that, you will get 70424 precisely. Are you getting this? Everyone? Anyone, any questions? Everyone getting this right? Correct. Okay. Both the questions we saw were of bonds or debt. Third, this question, corporation pays an annual dividend to shareholders and its most recent dividend was Canadian dollar 2.4. When they say most recent means D0. This seems to be like Gordon's growth. Analyst following this company expects the company's dividend to grow at a constant rate of 3% per year in perpetuity. So it's a constant growth model and required return of 8% per year. What is the expected price? So constant growth model, what is the price? The intrinsic value we calculate here under the constant growth model, which I call P0, is D0 into 1 plus growth. That gives me D1 over R minus G. R is cost of equity. Okay. So here my D0 is 2.4. Growth rate they have given me is 3%. Over 8 minus 3, you can directly do 5%. So here you will do 2.4 into 1.03 divided by 5 and then press percentage sign, that is 0.05. You'll get 49.44. Are you getting this? This was equity question. Yes. Anyone, any doubt? Got this? Yes. This was still simpler because it was a constant growth model, a single stage model. The next one, let's see the next one. Company announces it expects significant cash flow growth over the next 3 years. And now it plans to increase recent 2.4 dividend by 10% each year for the next 3 years. So guys, for the next 1, 2, 3, company is saying that the dividend will grow at 10% till the 3rd year. And what happens after 3rd year? Following 10% growth, company Melandia is expecting to grow annual dividend by constant rate of 3% indefinitely. So after 3rd year, the growth will become 3%. Now, this tells me that my terminal value should be calculated at 3rd year. terminal means the last year value, which I call P3. Why so? Because after third year, the growth is perpetual. So to calculate P3, we require the next year dividend over R minus G. Correct? And they have said required return is 8%. What is the expected share price? Basically, I have to calculate P0. So before I calculate P0, what will be the components over 3 years? Over 3 years, I'll get dividend next year 1, dividend 2, dividend 3, and P3. Now see this. These all values will be different. This will be my cash flow in year 1. This will be my cash flow in year 2. In the third year, I have two cash flows, D3 and terminal value, P3. Both are in third year. Okay. Now see, how do I solve it? I'm sure you might be probably aware, but I'm just adding few things here. So in this case, I have my D0 as 2.4. So in your calculator, put 2.4 into 1.1, you get 2.64. Are you getting 2.64? Right? Store it. Store this 2.64. Store 1. Store 1. Now on the same value, times it with 1.1. Multiply it with 1.1 again. You will get 2.904. Are you getting 2.904? Store 2. Store 2. Again on this, multiply with 1.1, that is third year growth, that is 3.1944 you will get. I'm writing 3.19 here, but you do store 3. Store 3. So you have all 3 dividends. Now to calculate P3, you require D4, for which you have D3 on your calculator screen, that is 3.19. Times it with 3%. So do multiply with 1.03. You will get 3.29 as D4. Are you getting 3.29? Now, one thing you have to do manually is 8% is the cost and the growth is 3%. So 8 minus 3 is 5%. So whatever is your answer, 3.29 divided by 0.05, you'll get 65.8. Put that store 4. 65.80. Put that as store 4. Have you done this? Everyone? Do you want me to solve it on the calculator? Okay, see first. Okay, I will solve each one by one. So you had 2.4 into 1.1 equal to store 1. That's my D1. On this into 1.1 equal to store 2 into 1.1 again equal to store 3. Now after third year, the growth grows 3%. So into 1.03, this is my D4 divided by 8 minus 3%, that is 5%. So divided by 5%, I get 65.8 store 4. Now go to the cash flow function, clear your previous karma, second clear, everyone, right? CF0, nothing. Right now, I'm not investing anything. I'm going to get cash flows in the first year. So skip CF0, go to C01. All you have to do is press recall 1, enter. C02, recall 2, enter. But in C03, remember there are two values, third year dividend and terminal value. So you need to add both. You need to add your recall 3 plus recall 4 equal to, and then press enter. Understood this part, everyone? Recall 3 plus recall 4, that's D3 plus P3, terminal value, right? Now, when you press NPV, it won't give the answer because it will ask you for what is the discounting rate. Our discounting rate was 8%. So press just 8, enter, down arrow, and then don't forget to press compute. If you press compute, you'll get exact answer 59.707. That is 59.71 approximately. And that's your answer C. Timeline equation calculation. First, you make a timeline, then make a proper equation, then you do calculation TEC. This is what I say. Whether you remember me or not, remember the technique that I put here, TEC. TEC. Timeline equation calculation, timeline equation calculation, timeline first equation, then calculation. This gives you accuracy. Don't worry about speed. Perfect. Clear. How's it? Good. Very nice question, isn't it? Yes. Next. I'll move on to the next one. Anyone has any doubts? Yeah. Okay. Consider Swiss Confederation a zero coupon bond with a par value of 100, a time remaining to maturity 12 years, and a price of this. So I have PV, I have the FV is always 100 in a zero coupon bond. I've got the PV, 89 is the price today, and 12 years is remaining to maturity. In 3 years time, means after 3 years from today, the bond is expected to have a price of 95.25. If purchased today, the bond's expected annualized return. Now see this. How much did you invest today? That's going to be your PV. How much did you exit after 3 years? That's going to be your FV. In between, your PMT is 0 because it's a zero coupon bond, and N is 3. Okay. But remember one thing. Before you calculate, one rule that you need to know, that the PV and FV cannot have the same sign. One is an outflow, another is an inflow. So always remember, keep both different signs. Otherwise, your calculation will show error. So in your calculator, 89 negative should be PV, 0 should be your PMT, 95.25 should be your FV because that's the price at which you exit. 3 is your N, 0 is your PMT. As I said, compute I by Y, you will get an answer. May I get an answer from everyone? I'll wait for your answers. Yes, anyone? 2.288, that is 2.89. 2.29, sorry, 2.288, that is 2.29. Clear? Perfect. Yes, great. Remember the rule, PV and FE never should have the same sign. So one is negative, the other is positive. Whichever you do, doesn't matter. Okay. Next, company issued 10-year corporate bonds 4 years ago. So how much life remains? 6. You always think how much life remains. The bond pays annualized coupon of 10.7 on semi-annual basis. So whenever there is semi-annual, everything multiplied with 2, your coupon or PMT is 10.7 divided by 2. Current price, PV is given to me, FV is also given, YTM of the bond. Okay, so all I have to do is 6 into 2, 12 will be my N, 10.7 divided by 2 will be your PMT coupon, 5.35 will be your coupon. PV, remember PV, put negative sign, PV 97.5, 100 put FV and compute I by Y, you will get an answer of 5.64. But remember, this is semi-annual I by Y. Your I by Y is semi-annual 5.64. You need to multiply with 2, whatever your answer is. On the screen, you will get 11.28%. That's your annualized I by Y. I've seen many CFA Institute questions where they put 5.64 as one of the choice here, and students in hurry click that. Correct? Understood, everyone? Next, stock trades at 60 right now. The company pays annual dividend to the shareholders, and it's most recent means D0 is D0. Current dividend is 2.4. Analyst following company expects dividend to grow at a constant rate of 3% per year. Company's required return is okay. So now considering Gordon's growth model, what is Gordon's growth model? P0 is D1 over R minus G. Now I have my P0 that at 60, the next year dividend, that is 2.4 into the growth rate 1.03. What cost of equity will give me 60. Now you can do trial and error here. You can start with 8. So 8 minus 3 is 5%. So you can do 2.4 into 1.03. I store it first. That's 2.47 divided by, if the cost of equity is 8, so I will do 8 minus 3, that is 5, divide by 5%. That gives me 49.44. No, but my value should be 60. So I'll reduce the rate to 7. If I do 7, 7 minus 3 is 4%. So I do 2.472. That's my recall one. 2.4 into 1.03. Divided by 4%, I get 61.8, still not 60. Therefore, I go to the last one, 7.12 minus 3%, that is 4.12%. So by taking this 4.12%, okay, I will do again recall one, that is 2.472 divide by 4.12%. I get exactly 60. So my answer is C. Of course, you can put the calculator and resolve it, but no need to waste time. Just put the choices, do trial and error, get the answer. The answer should be equal to the price that they've given. Clear, everyone? Got it? Next. Analyst observes the benchmark Nifty 50 stock index trading at a forward PE ratio of 15. Okay. Index expected dividend payout ratio is 50%. So my payout ratio is dividend over earnings. D1 over earning is 0.5. Required return is 7.5. Okay. And the company says that its constant growth rate is 4.5%. Which of the following statement is correct? Now, first of all, based on this, what am I supposed to do? All this information that they've given, so much of information. This is the information of justified PE ratio. What is a justified PE ratio, guys? Justified PE ratio. This is from, by the way, equity. Justified, and that's to leading PE ratio. It's next year. Justified leading PE ratio is payout ratio, D1 over earnings over R minus G. Now my payout ratio is 0.5 divided by R minus G. So R minus G is 7.5 minus 4.5. That's 3%. So if you do 0.5 divided by 3%, this gives you 16.67x. This many times should be your PE ratio. Correct? But they have given me the actual PE ratio. Actual PE ratio that they have given based on the trading that is happening in the market, they've given me is how much? 15. So what does this mean? It means that the market is quoting the stock at 15 times of its expected earnings. But in reality, based on my equation, it should be 16 times. So it is quoting at 15, but it should be 16.6 times. So then my conclusion would be the index is undervalued. I'll repeat, because the PE ratio is lower, the actual PE ratio, like price, the actual price is lower than the intrinsic value, then the justified PE, then I would say the stock is underpriced. Okay. So let's see the conclusion. The analyst should view Nifty 50 as overpriced. No, should view as underpriced. Yes. Fairly priced would be when both are same, which is not the case. Clear? Right. This is with regards to question number 8. Next, if you require 8% return and must invest USD 500,000, which of the investment opportunities would you prefer? So you have two choices, opportunity 1 and 2, both have same investment, and then you have these cash flows. What am I supposed to calculate, guys, in this case? In this case, what exactly will you do? Do you have returns? Yes, they've given you the cost of discounting factor is 8%. All you have to do is calculate the NPV of this. The NPV of this will be your answer. You can do NPV, or you can simply do the present value of all of this and see which is giving you, because the investment is same. So you can just simply do the present value of both and see which one is giving you higher value. Okay. So go to your cash flow function, second clear. I put C01 as 195. And guys, since the cash flows are same, you can put the frequency 3. I'll repeat, since the cash flows are same. So CF second clear. Okay, my C01, the value, okay, I need to second clear because there were some values. Just cross check it always. So my C01 was 195, enter, and 195 is thrice the same amount. So you can put frequency 3, enter, press NPV. The discounting rate they have given is 8%. So 8, enter, compute the present value. I get 502. So my first case, I get the present value. I will just say the present value of all the cash inflows, present value of all cash inflows. I get 502 in the first case, right? 502.53 to be precise. 502.53. Second case, I have different cash flow, 225, 195, and 160.008. So I'll go cash flow second clear. Cash flow second clear. What was my cash flow in first year? It was 125. No, 125 or 225? 225, 195. 225, enter. C02, 195, enter. 225, 195, and then it was 160.008, enter if I'm right. NPV discounting rate will remain the same. Down arrow, compute, you get 502.53. Exactly same. 502.53. So, conclusion, I am indifferent between both the opportunities. Understood, everyone? Clear? Right? Thank you. Next. Italian 1-year government debt has interest of 0.73. 2-year government debt has interest of 1.29. The break-even 1-year investment reinvestment rate. Now, this is actually from bonds, something called as spot and forward rates. So what I'll do is that I will perhaps solve this using the timeline. So this is question number 10. What they have given me is 1-year rate from today, which is called the spot for 1 year. And what is the 1-year rate? 0.73, and 2-year is 1.29. This is 0.73 percentage. And 2-year rate, that is 2-year spot rate from today. So, sorry, I'll write it better. This is 1-year spot rate, 0.73 percentage. And 2-year spot rate is 1.29. Am I correct? 1.29. Now, what is this rate between 1 and 2 called? This rate between 1 and 2 is called 1 year forward after 1 year. It's a 1 year forward after 1 year. So how do I solve this? Let's make this equation. Suppose you invest $1 for 1 year. It will become 1.073%, means 1.0073. Then you will reinvest for another year at a rate of 1y 1y. 1y 1y is 1 year forward rate after 1 year. This should match to the 2-year spot rate 1.0129 square, because it's a 2-year rate. Right? This is what we do in fixed income. Okay. So now I want to solve this 1 by 1 by. So what I'll do, 1.0129 square, divide this by 1.0073, minus 1 will be my 1y 1y. That is 1 year rate after 1 year. Let's solve this. 1.0129 square divide by 1.0073 equal to minus 1 into 100. You will get, anyone with answer? 1.85. Check it. If you have that A, not B, C is your answer. Understood, everyone? Right? Okay. Clear? Right? Okay. This was very complicated. This was actually bond question that they added into time value of money. Imagine someone who starts CFA with QM, and the second topic he comes to time value of money and he's completely lost as to what's going on. So much of complexity. So, this is what happens. So that's why in my class, I tell students do this after you're done with everything. So there are some complications as to what to start, what to end. A lot of students, they generally start with whatever is the first book, so they immediately start with the first book. Previously, what used to happen, that the first topic was ethics. So people used to start with ethics and they found CFA very boring initially, and they were like, okay, what to do with after ethics? I'll go with the flow only. So I had to convince them, brother, let's do ethics at the end. Why? Because you need to know how the business and everything works, and then you can do ethics. And even if you studied ethics earlier, it is very natural that by the time you reach the end, you'll forget it. So I generally recommend ethics not to start. I don't recommend to start with ethics. But since many students see the book and then they see the first book, first topic is ethics, it was difficult for me to convince them that we can skip ethics. Now, what they did, they put ethics at the end. So now I don't have to convince them for ethics, but still there is some inefficiency where I have to tell them we are not doing second reading. Don't worry, I'll cover that afterwards. So, it's very difficult, but you have to tell the student that why the flow is important, why I need to tell them that what do we start with first, what do we end, and all that. That flow is very crucial in CFA. Otherwise, people find CFA very difficult and they cannot connect the story. CFA is a whole story. By the time you reach the first and second topic, you think it's too much of a burden. You feel somewhere lost. You always feel, how will I remember it? But by the time you reach the end, you start connecting the dots, and then you realize memorizing is not at all an issue. Trust me, the preparation of CFA is very difficult, but the exam is very easy. But the process is important. The process is you do at least 2 to 3 revisions of whatever notes you refer, practice a lot of questions. Okay. And now, since I'm going to upload this also on the channel, you can keep on practicing as much as you can. Practice, revise, practice, revise, practice. More or less, the questions are going to be similar in the similar lines. They're not going to ask you something rocket science out of the box. No. Got it? Let's do this 2 questions and then we can do further discussion. Here they have put the currency information. So they are expecting us to know interest rate parity in the second topic itself. Current exchange rate between euro and US dollar is this. Now, by the way, this is the rate of euro. Euro being in the CFA Institute, we use price/base currency format. So that means euro is the base currency and USD is the price currency. Okay. So this is the spot rate, correct? Current exchange rate means spot rate. Risk-free rates for 1 year are 0.75% in euro and 3.25% in dollar. 1 year US dollar euro forward rate. Now, guys, to calculate the forward rate, I need the spot rate into, if you use compounding, you use 1 plus interest rates. But here in quants, what they've done is that they've used exponential returns. Means you will use exponential, e to the power of rate of interest. But which rate of interest? Here, the rate of interest is always about the price currency divided by the rate of interest of base currency. This you can compress the formula as spot into e raised to, the bottom goes, the denominator can go on the top. You can do e raised to rate of price currency minus rate of base currency for the time period. So what is my spot rate? 1.025 into e raised to, what is the price currency? 3.25 minus 0.75. So 3.25 minus 0.75, that's 2.5 percentage for how long? 1 year. So I don't have to worry, raised to 1. Now, how to solve this? In your calculator, put 2.5% and then press second ln. Press second ln. Everyone, I'll show you. You will do 2.5% press second ln. It will give you 1.0253 and then times it with 1.025. The spot rate times 1.025. You get an answer of 1.0509 or 1.051. 1.051. Okay. So the value of euro compared to the spot has gone up. Also, this is interest rate parity. By the way, in the interest rate parity, the base currency here is euro. If the euro's interest rate is relatively lower, then in forward, the euro will go up. It will be at premium. So since euro's interest rate is relatively lower than the dollar, euro's interest rate should go up. Euro's forward rate should be higher than the spot. Why is the rate higher? Because relatively the interest rate of euro is lower. Opposite would be the case. If euro's interest rates were higher, its currency would go at discount. That's the concept of interest rate parity. I will discuss that further. I mean, I've discussed all this thing further in the topic of economics. How is this derived? Clear, everyone? Yes. The last one is related to binomial, basically. It's not exactly option, but somewhat related to the option hedging ratio. Okay. I'll explain this. Stock currently trades at 25. So the current price of the stock is 25. In 1 year, it will either increase in value to 35 or decrease to 15. So two possibilities like binomial. If the stock goes up or if it goes down, I write SUNSD. If it goes up, it will be 35. If it goes down, it will be 15. Investor sells a call option, correct? Where he has an obligation to buy the stock at 25 in 1 year. So 25 is also my strike price. Now, sells a call option means he's short call. But you will always think from long because long has the right to exercise. So if the price goes up, what will be the gain for long? $10. Correct? 25 and 35. But if the price goes down, she will not exercise. So this will be 0. This gain or loss will be for the long, but I'm short. I'm a short. So my answer will be opposite, negative. Clear? So what's the point here now? At the same time, they said investor buys 0.5 units of stock. Means along with this short call, he has a long stock position. But how much? For every one call, he has 0.5 stock. So what was the stock value? 35. So stock went on to become up. So how much will be my portfolio value? 35 into 0.5 because they said I bought half stock. Of course, you can't buy half stock. It's just a fraction that they've mentioned. This will be 15 into 0.5. Let's see what's the cash flow. What's the value of portfolio? So 35 into 0.5, that is 17.5 minus 10. This will be 7.5 if the value goes up. And this will also be 7.5 if the value goes down. What is the question? Which of the following statement about the value of investors' portfolio at the end of the year is correct? The portfolio has a value of 7.5 in both the scenario. A is the answer. Understood, everyone? This is, by the way, related to hedge ratio concept in derivatives last topic. Imagine you do derivatives at the end, and into that also you do at the end the hedge ratio, and that they have put in the beginning in time value of money. Okay, so someone who starts with QM, they will be like, what is going on? Okay, clear? Every question, right? We've done with 2 readings. The rest of the reading I'll do in the session, in the next session. And the rest of all the readings I'll cover up in the next session. You have any questions, let me know. I'll also take any general questions if you have, you can ask me. And whatever is the raw video, I'll upload it. Don't worry. Yes, any questions? I'll be uploading these notes also. So I will tell you where these notes will be available. I'll email that to you all as well.